So when you pull out your phone and, ask an AI to generate an image, or you're just streaming a 4K movie, or even reading about this massive push for the green energy transition, you are essentially interacting with the digital ghost of a very physical reality.
Oh, absolutely.
Right. Like, we tend to visualize the future in terms of, sleek server racks, flashing lights, or these pristine solar panels out in a field.
Yeah, the clean stuff.
Exactly, the clean stuff. We picture the complex engineering, the steel, the concrete. But before a single server is even plugged in, or before a massive earth mover starts clawing into the Canadian permafrost, or the Australian outback for that matter, to mine those raw materials, there is this entirely different, incredibly human element that has to be solved first.
And it is completely ignored by most people.
Right. And that element is simply this. Where do the 3,000 human beings who are actually building this futuristic infrastructure, where do they sleep, eat, and shower when the nearest grocery store is like 400 miles away?
I mean, it is basically the single most overlooked logistical puzzle in global macroeconomics today.
It really is.
Because you absolutely cannot build a multi-billion-dollar liquefied natural gas terminal or a sprawling, power-hungry AI data center in some remote wilderness if your workforce doesn't have a reliable, safe, and frankly, heavily climate-controlled place to exist.
Yeah, we aren't just talking about throwing down some sleeping bags in a canvas tent.
No, not at all. These are highly skilled, highly paid union workers. They demand high-speed internet, premium food, gym facilities, medical care. You are essentially being asked to build, staff, and manage a temporary, fully functioning city.
A temporary city that just appears out of thin air, operates flawlessly for maybe 3 to 5 years, and then completely vanishes.
That's gone.
Exactly. And this is the exact reason we are pointing our microscope at Civeo Corporation today. The ticker is CVEO. We're doing a specialized Talk Tickers deep dive into their Q2 2026 earnings call.
Which is a fascinating one, by the way.
Oh, it really is. Our goal here is to just take this massive stack of Wall Street jargon, strip it down to the raw data, and tell you exactly what this means for your portfolio. So for those of you who haven't tracked this specific niche of the market, Civeo is just an absolute heavyweight in remote workforce accommodations.
Yeah. They are the landlords, the chefs, the housekeepers, the facility managers for the biggest infrastructure projects on the planet.
Which is precisely why reading their earnings transcripts is so valuable, even if you don't ultimately end up buying the stock.
Oh, 100%. I mean, Civeo acts as this critical leading indicator for the broader global industrial economy.
Because they're the first ones in.
Right. They are the literal first boots on the ground. Before the steel is poured, before the heavy machinery arrives, their bidding pipeline tells you exactly what the biggest energy and tech companies in the world are actually preparing to physically build, rather than, what they're just talking about building in their PR materials.
Right. PR is cheap. Pouring concrete is expensive. Okay, let's unpack this, starting with the headline numbers from the second quarter, because at first glance, they present a bit of a riddle.
They definitely do.
So for Q2 2026, Civeo reported total revenue of $180 million. That is a very solid 11% increase from the $162.7 million they reported in the second quarter of 2025.
Which is great.
Yeah, I mean, double-digit top-line growth in an industrial services sector is generally a reason to pop some champagne.
It is. And as we move further down the income statement, we see the net loss for the quarter came in at $2.5 million, which translates to about 23 cents per diluted share.
But wait, context is everything here, right?
Exactly. That is actually a year-over-year improvement. In the same quarter last year, they had a net loss of $3.3 million, or 25 cents per share. So the revenue is expanding and the net loss is narrowing.
Right, and the cash generation was even more aggressive.
Yeah.
They generated $11.6 million in operating cash flow this quarter.
Massive swing.
Massive. If you look at the same time last year, that number was negative $2.3 million.
Right.
So we have an almost $14 million swing straight into positive cash generation territory. But, and here is where we hit the metric that makes you stop and scratch your head, adjusted EBITDA.
Right. Adjusted EBITDA, which, stands for earnings before interest, taxes, depreciation, and amortization.
Just a mouthful of accounting terms.
Yeah, but it's the metric most analysts actually use to judge the pure operating performance of a business, mainly because it strips out the noise of tax environments and debt structures.
Right.
And for Civeo, adjusted EBITDA dropped slightly. It came in at $23.8 million for the quarter, which is down from $25 million in the prior year.
This is the riddle, though. For a retail investor trying to make sense of this, it feels super contradictory. I mean, revenue went up 11%, operating cash flow improved massively, but actual operating performance, measured by EBITDA, went down.
It's confusing on the surface, for sure.
It's like getting a massive 11% raise at your corporate job, keeping your spending exactly the same, but somehow logging into your bank account at the end of the month and realizing you have less cash left over than you did before the raise. Mechanically, how does a company bring in nearly $18 million more in top-line revenue, but actually lose ground on their core operating earnings?
That is the perfect analogy, and it illustrates exactly why you can never, ever just skim the top line of a financial press release and hit the buy button.
You got to look under the hood.
You have to. When we look at the mechanics of the specific earnings report, that contradiction was driven by a collision of two things. On one side, macroeconomic currency impacts, and on the other, highly localized temporary cost friction.
Okay, let's isolate the currency impact first, because this trips up so many people who invest in multinational microcaps. Civeo is headquartered in Houston, Texas, but a massive chunk of their actual business happens in Australia and Canada.
Exactly, and that geographical footprint is the absolute key to understanding that 11% revenue bump.
The $17.3 million increase.
Right. That year-over-year increase in consolidated revenues was heavily flattered by foreign exchange rates. Specifically, the Australian dollar strengthened significantly against the US dollar over that time period.
Okay, so walk me through that. When Civeo rents a room to a mining company in Queensland, they get handed Australian dollars.
Correct.
But when Colin Jerry, the CFO, sits down in Houston to write the Q2 earnings report for Wall Street, he has to legally convert all those Australian dollars back into US dollars on the spreadsheet.
Yep, that's the rule.
So because the exchange rate shifted in their favor, the exact same amount of underlying physical business, the exact same number of beds slept in and meals eaten, magically looks like a massive revenue increase on the US income statement.
You nailed it. It is entirely an accounting reality, not necessarily an operational explosion. Now, I mean, to be fair to management, they did have some genuine organic growth.
Right. It wasn't all just fake money.
No. They acquired some new villages, they expanded their integrated services in Australia, and they won a major new contract in Ontario, Canada. But a very large portion of that 11% raise was just the wind at their back from global currency markets.
Which perfectly explains why the revenue looks so good without corresponding profit. I mean, if currency fluctuations inflate the revenue number on the spreadsheet, they also inflate the cost number on the spreadsheet. The raw margin percentage doesn't actually change.
Exactly.
But that still doesn't fully explain why the EBITDA physically dropped from $25 million down to $23.8 million. Where did the margin actually bleed out?
So the margin compression happened for two completely different reasons in their two main geographies. In Canada, they suffered from upfront startup costs for that new Ontario contract.
Okay.
And in Australia, they were hit by very real physical inflation related to diesel fuel.
Okay, we are going to dive deep into both of those because the underlying stories there are just fascinating. Let's start with the Australian engine. Bradley Dodson, the CEO, explicitly called Australia the strength of our business on the call.
And the raw revenue backs him up there.
It does. Australia generated $125.4 million, up 11%. But here's the critical data point that caught my eye. The actual physical build days at their own villages dropped. They went from 691,000 build days in Q2 2025 down to 675,000 days this quarter.
What's fascinating here is the root cause of that drop in occupancy. Because usually when a remote accommodation provider sees a drop in build days, your immediate thought is that the underlying commodity market has crashed.
Right, like the mines are going bust.
Exactly. If the mining companies aren't making money, they fire workers and those workers leave the camps. But that is definitively not what is happening here.
Right, because the primary driver of Civeo's Australian business is metallurgical coal, which, for the listener, is the high-grade coal required to manufacture steel, entirely distinct from the thermal coal you burn in a power plant.
A crucial distinction, yes.
And just to ground this in the current data, metallurgical coal is sitting comfortably above $220 a ton right now. We know from historical commodity cycles that anything above roughly $150 a ton basically means these Australian Tier 1 mines are absolute cash printing machines.
Exactly. The mining operators themselves are highly profitable at $220 a ton. They have every financial incentive in the world to pull as much coal out of the ground as humanly possible while prices are this high.
So I have to play devil's advocate here. If the mines are wildly profitable and they want to maximize output, Why on earth did Civeo's build days drop?
It's a great question.
I mean, why wouldn't the mining companies be aggressively stuffing every available room in a Civeo camp with extra casual laborers to dig up more coal?
This is where global macro geopolitics slams directly into the microcap earnings report. Management explicitly cited customer caution regarding fuel cost and availability, which they linked directly to the ongoing seaborne trade dislocations in the Middle East and the Red Sea.
Okay, I want to break down the actual mechanics of that because it sounds almost absurd on the surface. How does a rebel group firing a drone at a cargo ship in the Red Sea cause a mining camp in the Australian outback to have empty beds?
It comes down to the fragility of global supply chains. Look, Australia is incredibly rich in natural resources, but they have very little domestic oil refining capacity left.
Really? I didn't know that.
Yeah, they import the vast majority of their refined diesel fuel, much of it originating from refineries in the Middle East or India. So when conflicts in the Red Sea or the Strait of Hormuz escalate, two things happen.
Okay.
First, insurance rates for oil tankers spike. Second, many shipping fleets refuse to transit those waters entirely, opting instead to reroute all the way around the Cape of Good Hope in Africa.
Which adds weeks to the journey.
It adds weeks to the journey, and it ties up the global tanker fleet, drastically reducing the supply of available ships. So if you are a massive mine operator in Queensland, Australia, your entire operation, the massive dump trucks, the size of houses, the excavators, the local power generators, it all relies on millions of gallons of diesel fuel arriving exactly on schedule.
Oh, wow. I see where this is going.
Yeah. So if your procurement officer taps you on the shoulder and says, our next diesel shipment is delayed by 3 weeks because the tanker had to reroute around Africa and the price just spiked 15%, what do?
You conserve.
Exactly.
You don't greenlight the extra weekend shifts. You don't hire the additional 500 casual contractors to clear new topsoil. You stick strictly to your baseline operations to ensure you don't run out of fuel entirely.
You operate conservatively. You pause your marginal expansionary activities, and those marginal activities are exactly what fills the casual occupancy rooms in Civeo's villages.
The baseline is safe, but the extras get cut.
Right. The mining companies maintain their long-term baseline contracts with Civeo, but they stop booking the extra short-term rooms. That hesitation, driven entirely by a fuel supply chain bottleneck thousands of miles away, is what squeezed Civeo's build days down to 675,000.
That is a brilliant breakdown of how interconnected this all is. It's the ultimate butterfly effect. A shipping lane closes in the Middle East, and a caterer in Australia serves 16,000 fewer breakfasts over the quarter.
It's wild, but that's global economics.
But let's stay in Australia for one more moment because we have to touch on this integrated services target they keep emphasizing. Dodson said they're aggressively marching toward an annual revenue run rate of 500 million Australian dollars for their integrated services segment by the end of 2027.
That's a huge target for them.
Mechanically, how does that differ from what they currently do in their own villages?
So it represents a fundamental shift in capital intensity. In their traditional own villages model, Civeo basically acts as a real estate developer. They have to buy the land, permit it, buy the physical modular rooms, pay to install them, and maintain the infrastructure. It requires massive upfront capital expenditure.
Huge sunk costs.
Right. But the integrated services model is essentially an asset-light pivot.
Meaning they don't own the buildings.
Precisely. In the integrated services model, the mining company, say BHP or Rio Tinto, already owns the camp. They own the buildings and the land. But they don't want to deal with the headache of hiring chefs, managing housekeeping staff, maintaining the HVAC systems, or running the water treatment plant.
They just want to mine coal.
Exactly. So they contract Civeo to come in and run the entire hospitality and facility management operation. Civeo provides the labor, the software, and the logistics, but they don't have to deploy millions of dollars to build the physical rooms.
I get it.
So pushing that specific asset-light revenue stream to a 500 million AUD run rate massively improves their return on invested capital because they're generating cash without having to lay out heavy capex.
And that capital they free up in Australia doesn't just sit there. It's what allows them to aggressively fund their expansions elsewhere. Which brings us directly to what's happening in Canada.
Canada is a great story right now.
Canada feels like the coiled spring of this company right now. Revenue in Canada rose to $54.6 million, up from $50 million last year. Build rooms in Canada actually ticked up, hitting 458,000 days. The average daily rate crept up slightly, but again, we see the EBITDA squeeze. Canadian adjusted EBITDA dropped from 6.9 million down to 6.0 million.
And this brings us back to those startup costs we mentioned earlier. Canada's revenue growth was driven by a higher general occupancy and the launch of a major new integrated services contract in the province of Ontario.
Right.
But winning a massive new contract is kind of a double-edged sword in the first quarter of operations.
Yeah, because before you can bill the client for the first meal served or the first room cleaned, you have to mobilize an army.
You really do.
I mean, if I'm taking over a 1,000-person camp in northern Ontario, I have to fly in management teams, recruit and train hundreds of local hospitality workers, set up entirely new supply chains for industrial-scale food delivery, install my proprietary software systems. All of that requires millions of dollars in upfront cash burn.
That is the exact friction dragging down the Canadian EBITDA. It is simply the cost of future growth.
So it's temporary.
Yes. The crucial takeaway for investors is that management was very explicit that these are temporary, localized friction points. Once the Ontario contract settles into its steady state operational rhythm, once the staff is trained and the supply chains are optimized, those upfront costs vanish.
And the margins go back to normal.
The margins will normalize, and that top-line revenue growth will finally flow unencumbered down to the EBITDA line in subsequent quarters.
Okay, so the base business across both continents is fundamentally sound, just dealing with some temporary turbulence. But the actual bombshell of this earnings report didn't happen in the Canadian oil sands or the Australian outback. It happened in the boardroom in July, right after the quarter closed.
Oh, this is the best part.
This is where we need to put on our corporate finance hats, because management executed a massive, highly aggressive capital allocation maneuver. They issued $115 million in 4.5% convertible senior notes due in 2031 and immediately used the cash to pay down their revolver and buy back a shocking amount of their own stock.
This is the most critical part of the deep dive. This single maneuver tells you exactly what management thinks their company is actually worth compared to what the public market is currently pricing it at.
Let's take this piece by piece, because convertible debt can be incredibly confusing for retail investors. What exactly did Civeo do here?
So they went to institutional investors and borrowed $115 million. In exchange for that cash, Civeo issued senior notes, which is just corporate jargon for bonds that mature in 5 years in 2031.
Okay.
For those 5 years, Civeo agrees to pay those bondholders a fixed annual interest rate of 4.5%.
Now, I have to stop you there. In the current macroeconomic environment, getting an unsecured corporate loan at a fixed 4.5% is incredibly cheap.
It's unheard of right now.
Right. A company of Civeo's size, issuing standard high-yield debt right now, would likely be paying 7, 8, maybe even 9% interest. How do they convince institutional investors to accept a measly 4.5% yield?
They got that steep discount on the interest rate by adding the convertible feature. The bondholders agreed to take a lower cash yield today in exchange for a massive embedded call option on Civeo's future.
A lottery ticket.
A lottery ticket, exactly. The contract states that the bondholders have the right, under certain conditions, to convert that $115 million in debt into shares of Civeo common stock, but only at a very specific price, which is called the conversion price.
And what did they set that conversion price at?
They set it at $40.51 per share.
Which is key, because when they priced this deal on July 1st, Civeo stock was trading roughly 20% lower than that.
Exactly. Management essentially said to the bondholders, look, we will pay you a safe, steady 4.5% a year. But if we execute our strategy, if this massive pipeline of mega projects hits and our stock price rockets up to $50 or $60 a share over the next 5 years, you can convert your debt into equity at the artificially low price of $40.51, and you get to capture all that upside profit.
The bondholders accepted a lower interest rate to buy a lottery ticket on Civeo's upside.
Exactly.
But hold on. This is where retail investors rightfully get terrified of convertible debt. If the stock does go to $60 and these massive institutional bondholders suddenly convert $115 million of debt into millions of new shares of common stock, doesn't that massively dilute the existing retail shareholders?
It's a huge fear.
Right? Doesn't that just slice the pie into way more pieces, making everyone's shares worth less?
In a traditional convertible structure, yes, the dilution can be brutal. But Colin Jerry, the CFO, addressed this exact fear head on during the call, and the mechanics of how they structured this are vital to understand. Civeo elected a specific settlement method.
Okay, what does that mean?
They stated their current intent is to satisfy the principal amount of this debt. the core $115 million, entirely in cash when it matures.
Okay, walk me through what that actually looks like in practice. Let's create a scenario. Let's say it's 2031, the bonds mature, and the stock is trading at $50 a share. What happens?
Okay, because the stock is at 50, which is higher than the $40.51 conversion price, the option is in the money. The bondholders want to convert.
Naturally.
But Civeo won't just hand them millions of shares for the whole amount. First, Civeo takes $115 million in pure cash from their balance sheet and hands it to the bondholders to pay off the principal loan.
Just wiping out the base loan.
Right. That completely wipes out the core debt without issuing a single share.
But the bondholders are still owed the profit from the conversion premium, right? The difference between the $40.51 strike price and the $50 market price.
Correct. That excess value, and only that excess value, is what gets converted into equity. Jerry explicitly stated that this transaction is not expected to result in net share dilution unless the stock price goes above roughly $53 per share, taking into account some capped call transactions they entered into to further protect against dilution.
Wow.
And even then, they retain the contractual flexibility to settle that excess premium in cash, too, if they had the liquidity. It is a highly defensive structure designed to protect the retail shareholder from massive dilution while still securing incredibly cheap debt.
That is a masterclass in corporate treasury management, honestly.
Yeah.
So they secure 5 years of cheap, fixed-rate capital. What do they actually do with the $115 million the day it hit their bank account?
They played aggressive offense. First, they paid down the outstanding balance on their variable rate revolving credit facility.
Their credit line.
Yeah, a revolver is essentially a giant corporate credit card. By paying that down, they immediately lowered their near-term interest expenses because the revolver carried a much higher variable rate than the 4.5% they just secured. But more importantly, it restores their borrowing capacity.
It frees up the credit card.
Right, it gives them massive dry powder if they need to suddenly finance the construction of a new camp.
And the second thing they did with the cash is what blew my mind. They went into the open market and repurchased 660,297 shares of their own stock for approximately $22.3 million.
Huge move.
I have to push back here, though. Buying back stock is great, but metallurgical coal is at $220 a ton. We are arguably at or near the top of a macroeconomic commodity cycle.
That's a fair point.
If a massive global recession hits next year and coal drops back down to 120, Civeo's earnings will contract. Aren't they running the classic corporate playbook of buying back their own stock at the exact top of the market, effectively buying high?
That is the most important counter-argument to this entire thesis, and it's exactly what a skeptical investor should be asking. But you have to look at the scale of what management is doing here to understand their conviction.
Okay, lay it out.
This latest $22.3 million purchase didn't just happen in a vacuum. It officially completed a monstrous authorization they initiated back in April 2025 to repurchase 20% of the entire outstanding share count of the company.
I really want the listener to grasp the sheer gravity of that number. They didn't just buy back a few shares to offset executive compensation. They bought back 1/5 of the entire company.
Gone.
They took 20% of the shares completely off the board and retired them.
And they didn't pause to celebrate. The very same day they finished that 20% authorization, they immediately started buying shares against their next 10% repurchase authorization, which is now already 50% complete.
It's relentless.
It is. So, to address your point about buying at the top of the cycle management is looking at a set of internal data that the public market doesn't have yet. Bradley Dodson stated it plainly on the call. We continue to believe Civeo shares are undervalued, and the transaction reinforces this conviction.
So you're saying they aren't looking at the current coal price, they are looking at the pipeline of unannounced mega projects.
Exact.
They are effectively borrowing institutional money at a cheap 4.5%. to buy an asset, their own equity, that their internal models suggest will yield a massively higher return over the next 5 years.
Exactly. And their publicly stated framework is to return at least 75% of their annual free cash flow back to shareholders, primarily through these repurchases. For you, the retail investor, that creates an incredible concrete floor of support under the stock price.
Because there's a permanent buyer.
Right. You have a guaranteed, relentless, multi-million-dollar buyer in the market who steps in every time the stock dips.
And critically, they executed this massive buyback without destroying their balance sheet. By paying down the revolver, Civeo exited the quarter with total available liquidity of $82 million and a net leverage ratio of just 2.1x.
We should probably translate that net leverage ratio for the listener because it's a metric Wall Street throws around constantly.
Yeah, please do.
The textbook definition is that net leverage is calculated as net debt, which is your total debt minus whatever cash you hold, divided by your trailing adjusted EBITDA.
Okay, textbooks don't help retail investors. Give me an analogy. How should I intuitively understand 2.1x leverage?
Sure. Imagine your personal finances. Look at your total mortgage, your car loan, and your credit card debt. Now subtract whatever cash you currently have sitting in your checking and savings accounts.
Okay, I've got my net debt.
That is your net debt. Now take that final number and divide it by your annual pre-tax salary. If the result is 2.1, it means that if you devoted every single pre-tax dollar you earned to paying off debt, it would take you exactly 2.1 years to become completely debt-free.
In the world of highly cyclical, capital-intensive industrial services, having a leverage ratio of 2.1x is incredibly conservative.
Very safe.
It means they aren't overextended. They have a pristine balance sheet. They have $82 million in dry powder, and they have 5 years of fixed low-interest debt. This begs the obvious question, why do they need to hoard all this financial flexibility right now? What exactly are they preparing for?
They are preparing for the $1.5 billion elephant in the room.
Let's talk about the elephant.
And to understand that, we have to look at management's forward guidance and the massive contract pipeline they are sitting on.
Here's where it gets really interesting. Let's start with the baseline expectations. Management maintained their full year 2026 guidance completely unchanged.
It's flat.
They are still projecting revenue between $675 million and $700 million, adjusted EBITDA between $85 million and $90 million, and capital expenditures between $25 million and $30 million.
Maintaining guidance in a quarter where you faced surprise fuel inflation in Australia and startup friction in Canada is a massive signal of underlying stability.
Right, they absorb the hits.
It tells the institutional market that the core business model is shock absorbent. There were no negative surprises large enough to derail the annual projections.
But the real excitement, the reason management is buying back 20% of the company, isn't found in the 2026 baseline guidance. It is found in the pipeline.
Oh, yeah.
Management revealed they are currently actively bidding on a pipeline of projects exceeding $1.5 billion in total contract value. For a company with a market cap roughly the size of Civeo's, a $1.5 billion pipeline is staggering. What exactly makes up this number?
This pipeline is a perfect cross-section of the most critical infrastructure bottlenecks currently being planned in North America. We are talking about massive liquefied natural gas, or LNG, export terminals in Canada and Alaska, driven by global demand for cleaner transition fuels. Massive. We are talking about massive highline power infrastructure upgrades to support the electrification of the grid. We are talking about general mining, and critically, we are talking about the construction of hyperscale data centers.
Ah, data centers. The physical footprint of the AI boom.
Everyone's talking about them.
Every major tech conglomerate on Earth, Microsoft, Google, Amazon, Meta, is locked in an arms race to build massive gigawatt-scale data centers to train their next-generation AI models. But they can't just build these in downtown San Francisco or New York.
No room, no power.
Exactly. They require so much land, so much cheap electricity, and so much fresh water for cooling that they are being forced to site these facilities in incredibly remote rural locations.
And when you try to build $1 billion tech facility in a rural county that only has a population of maybe 2,000 people, you immediately run into the Civeo problem.
The logistics.
The local town does not have the hotels, the restaurants, or the plumbing infrastructure to support the 3,000 specialized union electricians, pipe fitters, and concrete pourers who have to live there for 3 years to build it. You have to bring in a temporary city.
But management offered a very nuanced, almost contrarian view on the AI data center boom during the Q&A segment of the call, didn't they?
They did, and it is a phenomenal piece of on-the-ground economic intelligence. Dodson noted that inbound interest from clients regarding data center construction was, quote, feverish at the beginning of the year.
Feverish.
But he explicitly stated that over the last few months, the fervor for what Civeo does related to that specific end market has softened a little bit.
I love this because it cuts right through the Wall Street hype. The market is blindly bidding up the stock of any company that even whispers the letters A and I.
Mm-hmm.
But the actual logistics provider, the guy who has to pour the concrete and feed the workers, is seeing a slight cooling in the frantic pace of deployment.
A reality check.
Exactly.
Yeah.
Why is it softening? Are the tech companies running out of money?
No, they aren't running out of money. They are running into the physical limits of the electrical grid.
Oh, interesting.
You can design the fastest AI chip in the world, and you can allocate $10 billion to build a data center. But if the local utility tells you it will take 4 years to upgrade the high-voltage transmission lines to deliver the gigawatt of power you need, the project stalls.
So they just have to wait.
The fever hasn't died, but it has collided with the reality of interconnection queues and transformer shortages. Dodson was quick to clarify, however, that even with a slight softening in the timeline for data centers, the overall aggregate opportunity set across LNG, power grids, and infrastructure is one of the most robust they have seen in the last decade.
And Civeo is armed to the teeth for this specific opportunity set because of what they already own. They aren't just bidding on these $1.5 billion worth of contracts with a promise to go to the bank, borrow money, and buy some trailers. They already own the physical assets outright.
This is their ultimate competitive moat. In Western Canada right now, they have 2,700 mobile camp room sitting idle, immediately available for deployment.
Wow.
Furthermore, they have between 7,000 and 8,000 semi-permanent oil sands lodge rooms that could potentially be disassembled and redeployed to new mega projects.
We need to dissect the difference between those two assets because Stephen Gengaro, an analyst from Stifel, specifically asked about this on the call. What is the actual operational difference between a mobile camp room and a lodge room? And why does having both matter to a retail investor?
It dictates the type of contract they can win. It comes down to project size, duration, and logistics. A mobile camp room is exactly what it sounds like. It is a highly modular, single-story unit, easily loaded onto a flatbed truck and transported down a highway.
Very nimble.
Dodson explained that these mobile assets are perfectly suited for mid-sized projects, say camp sizes of 250 to 1,000 people, and for project durations of 2 to 4 years.
Why the 2-year minimum?
Because the sheer cost of transporting hundreds of mobile rooms hundreds of miles, hooking them up to water and power, and then tearing them down again is massive. If a project only lasts 6 months, that logistics cost eats up the entire profit margin. You need at least 2 years of rental income to amortize the setup costs.
Okay, so that handles the mid-sized projects.
Yeah.
What about the 7,000 lodge rooms?
The lodge rooms are entirely different beasts. These are massive, multi-story, semi-permanent structures. You deploy these when a project requires a workforce exceeding 1,000 people.
Like a real hotel.
Yeah, exactly. When you bring 3,000 workers to a site, land availability becomes a massive bottleneck. You physically cannot spread out 3,000 single-story mobile trailers without taking up hundreds of acres. You have to build vertically.
But building vertically in a temporary setting sounds incredibly expensive.
It is exponentially more expensive and time-consuming to engineer, transport, and assemble a multi-story lodge. Therefore, Civeo will only deploy these assets if the client is willing to sign a contract for a project lasting 5, 7, or even 10 years to justify that massive upfront capital investment.
They need a long-term commitment.
Right. But because Civeo holds both assets, the nimble, quick-deploy mobile rooms and the massive high-density lodge rooms, they can credibly bid on literally any size project in the pipeline.
Which brings us to the most critical acronym in this entire sector, the absolute holy grail for industrial contractors, the FID.
The final investment decision.
Yes.
The FID is the exact definitive moment when a project proponent, whether it's a massive global energy consortium or a hyperscale tech company, officially signs the paperwork and commits the billions of dollars of capital required to actually execute the project.
It's the green light.
Up until the very second an FID is signed, every press release, every government permit, and every preliminary engineering bid is just talk. It's vaporware.
And management explicitly stated on this call that they expect something meaningful from this $1.5 billion pipeline to actually reach FID by the end of 2026.
That's their expectation.
But, and this is a massive warning flag for retail investors trying to perfectly time their entry into this stock, an FID announcement in Q4 2026 absolutely does not mean Civeo's earnings are going to skyrocket in Q1 2027.
No. This raises an important question about the actual mechanics of revenue recognition in this industry. When an FID hits the news wires, the clock starts ticking, but the high-margin cash does not flow instantly. The lag time is significant.
Walk us through this timeline. Let's create a hypothetical. Let's say a major Canadian LNG export terminal hits FID in late October 2026. Right. The client commits the capital. What physically happens next?
Okay, so based on the phenomenal Q&A session with analyst Steve Ferrazzani, Dodson laid out the exact historical timeline. After the FID is signed, it typically takes the client about 90 days just to get their internal corporate ducks in a row, finalizing budgets, allocating project managers.
That's 3 months right there.
Then it takes another 90 days of negotiation before the actual legally binding accommodations contract is officially awarded to Civeo.
So if the FID hits in October, Civeo doesn't even sign the final contract until April of 2027. We are already 6 months down the road.
Exactly. And then comes the actual physical mobilization. And this is where the margin profile of Civeo's business is so crucial to understand. The initial phase of these contracts is entirely focused on transporting the modules, clearing the land, pouring the temporary foundations, and hooking up the utilities.
The dirty work.
Dodson was incredibly transparent here. The transportation and installation phase is fundamentally low-margin work. We are talking about operating margins of around 10%. Civeo is essentially just acting as a general contractor, passing through the logistics and heavy trucking costs to the client.
So during the summer of 2027, Civeo will be generating millions in revenue, but very little actual profit.
Correct. The high margin profit, the cash flow that actually moves the stock price, comes later during the operational rental phase. And this is driven by how these contracts are structured. Most of Civeo's massive contracts are structured as take or pay.
Okay, stop there. Define take or pay for the retail investor, because this is the bedrock of Civeo's risk management.
Think of it like signing a lease for an apartment. When you sign a take or pay contract, the client guarantees a certain amount of base revenue. They agree to rent, say, 1,000 rooms for 3 years at a fixed daily rate.
Okay, pretty standard.
But if the project gets delayed and they only end up putting 500 workers in those rooms, they still have to pay Civeo the daily rent for all 1,000 rooms. The client takes all the occupancy risk. If they use the rooms, they pay. If they don't use the rooms, they pay a penalty that essentially covers Civeo's required rate of return on the asset.
It completely de-risks the capital investment for Civeo.
Exactly. The client pays the guaranteed rent, and then they pay separately for the daily variable hospitality services, the actual pounds of bacon eaten, the hours of housekeeping used. That combination of guaranteed high-margin asset rental and scalable daily services is where the massive free cash flow is generated.
But there's one more massive physical hurdle that CFO Colin Jerry pointed out regarding the timeline of mobilizing these assets in Canada. And it's something a Wall Street spreadsheet can never account for: the weather.
The weather window is a brutally unforgiving variable. If a contract gets awarded in the late fall, Civeo has to face the reality of the Canadian winter. Moving a convoy of 500 oversized mobile camp modules down remote, icy logging roads through the Canadian Rockies in January is technically possible, but it is exponentially more dangerous, incredibly slow, and massively more expensive due to heating requirements and specialized labor hazard pay.
It's the equivalent of trying to assemble a 1,000-piece Lego set while wearing thick winter gloves on a moving treadmill.
Yeah, that's exactly it.
The friction destroys the timeline. Summer is the only preferred window for heavy mobilization.
Which strings the timeline out even further. If you take an FID in late 2026, a contract award in spring 2027, and a summer mobilization for those that only generates 10% margins, it means the high-margin take-or-pay rental revenue won't truly juice Civeo's earnings until the very end of 2027 or potentially early 2028.
Wow.
The pipeline is massive, but it is a slow-moving freight train. It requires a profound amount of patience from the investor.
Speaking of immediate timelines, though, there was a very specific, almost hidden nugget in the forward guidance that we have to discuss. Management stated that they expect their Canadian revenue to grow by a staggering 20% year over year in the second half of 2026, compared to the second half of 2025.
It's a huge jump.
What on earth is driving a 20% jump in just a few months? Did they sign a secret data center contract?
No, this is a phenomenal example of localized operational timing and how macro commodity prices impact daily schedules. That 20% jump is being driven almost entirely by turnaround activity in the Canadian oil sands.
What exactly is a turnaround?
A turnaround is a massive, highly choreographed maintenance event. An oil sands upgrading facility runs 365 days a year under extreme heat and pressure.
Right.
Eventually, you have to shut the entire multi-billion-dollar facility down to clean the pipes, replace the valves, and inspect the pressure vessels. To minimize the downtime, the energy companies bring in an army of specialized outside contractors, welders, pipe fitters, inspectors who work around the clock for 3 to 6 weeks.
And an army of specialized contractors needs thousands of beds and tens of thousands of hot meals.
Exactly. Normally, the energy producers try to schedule these turnarounds in the second quarter during the spring shoulder season. But this year, oil prices were incredibly robust in the second quarter, partially due to the same Middle East conflicts that disrupted the Australian diesel supply.
Wait, I see the connection. Because oil prices were high, the Canadian producers didn't want to shut down their facilities and stop pumping oil. They wanted to capture the high prices.
Bingo.
So they delayed their scheduled maintenance.
Spot on. They delayed the turnarounds, pushing all of that maintenance activity and all of those thousands of contractors into the third and fourth quarters. That massive shift in scheduled activity is what is going to provide the 20% revenue boost to Civeo's Canadian numbers in the back half of the year.
Okay, we have covered an immense amount of ground here. We have dissected the 11% top-line raise that was heavily flattered by the Australian dollar exchange rate. We explored how macro geopolitical tension in the Red Sea created a diesel bottleneck that compressed the Australian EBITDA. We looked at the startup cost for the new Ontario Integrated Services contract. We debated the aggressive $115 million convertible debt issuance and the massive 20% stock buyback at the top of the cycle.
Covered a lot.
And we unpacked the realities of the $1.5 billion pipeline, the softening AI data center fervor, and the agonizing timeline of a final investment decision.
We have truly looked under the hood of the entire global operation.
So what does this all mean? It is time to fulfill the mission of this deep dive. Let's bring this all the way home for the retail investor listening right now. If you are analyzing this Q2 2026 earnings call, what is the final actionable verdict? Are we looking at a bullish or a bearish signal for Civeo?
As always on this show, I will take an opinionated stance based on the data we've analyzed. This earnings call is a solidly bullish signal, but it comes with a massive asterisk. It is strictly for the patient, multi-year investor.
Okay, explain.
If you are a day trader looking for a stock that is going to double on a hype cycle in the next 90 days, Civeo is absolutely not it. The immediate short-term action is likely neutral as they chew through the Canadian startup costs and the Australian fuel inflation. But if you have a 3 to 5 year time horizon, the fundamental structural setup here is incredibly compelling.
Let's break that verdict down into actionable advice, segmenting our audience. Let's start with the listener who already owns shares of Civeo in their portfolio. For current holders, what is the fundamental why behind holding through this current turbulence?
For current holders, the thesis is all about downside protection and capital allocation. Your downside risk is being aggressively, almost violently protected by management.
Through the buyback.
Right. By committing to return 75% of their annual free cash flow back to shareholders, and by already retiring 20% of the outstanding shares, management has poured a concrete foundation under the stock price. Every time the broader market panics and the stock dips, Civeo's Treasury Department is there with an $82 million war chest ready to buy the dip and retire more shares.
And regarding the bad news in the quarter, the margin compression in Australia due to fuel costs.
You have to view that objectively. That is a transitory macroeconomic headache. It is not a fundamental flaw in Civeo's competitive moat or business model.
Because coal is still booming.
Exactly. As long as metallurgical coal remains highly profitable for their clients, and at $220 a ton, it is, the underlying demand for human labor in the Australian outback is rock solid. Eventually, global fuel supply chains will adapt, shipping routes will normalize, and fuel inflation will subside. When it does, Civeo's margins in Australia will naturally expand back to their historical norms. The core cash flow engine of the company is fully intact.
Okay, so current holders can sleep well, knowing management is playing aggressive defense on the share price, and the core assets are healthy. Now, what about the prospective buyers? The retail investor listening to this who doesn't own Civeo, but is wondering if they should start building a position based on this $1.5 billion pipeline. What is their actionable advice?
For prospective buyers, you are essentially playing the catalyst game. You need to be monitoring the industrial news wires and the global financial press like a hawk. You are looking for very specific trigger words: Canadian LNG, grid infrastructure FID, and Alaska. The moment a major energy consortium or a hyperscale tech company announces a final investment decision on one of these mega projects, that is the ultimate catalyst for Civeo stock.
Because once that ink dries, it unlocks the massive operating leverage sitting in those idle assets.
Exactly. Think about their competitors. If a massive new project gets announced tomorrow, a smaller competitor would have to go to a bank, borrow money at 8 or 9% interest, wait a year to manufacture new mobile rooms, and then try to bid on the contract.
Civeo doesn't have to do that.
They don't. They have 2,700 mobile rooms and nearly 8,000 lodge rooms sitting idle, fully depreciated and ready to deploy immediately. The operating leverage is massive. When those assets transition from sitting idle to generating high-margin take-or-pay rental revenue, the cash flow generation is going to be explosive.
But you have to wait for it.
But as an investor, you have to establish your position before the broader market fully prices in that future margin expansion, which, as we discussed, won't actually show up on the printed income statement until late 2027.
It is the absolute classic value investing setup. You are buying into a company with a pristine 2.1x net leverage balance sheet. You have a management team that is aggressively returning capital to shareholders rather than empire building. And you have a massive, tightly coiled spring of future growth that is just waiting for the macroeconomy to flash a green light. You just have to possess the psychological fortitude to wait for the Canadian winter to thaw and the contracts to sign.
And if we connect this to the bigger picture, I want to leave you with a final, somewhat provocative thought to mull over as you research this sector.
Let's hear it.
We spend so much of our time in the financial media talking about the ethereal technological marvels of the future. We talk about the AI software revolution, the seamless transition to green solar energy, the reshoring of complex semiconductor manufacturing. We look at the trillions of dollars being modeled by Wall Street for these massive infrastructure supercycles.
Yeah, the digital utopia.
But we constantly forget that the laws of physics still apply. You fundamentally cannot build the digital future or the green future without moving millions of tons of physical earth.
And you cannot move that physical earth without thousands of human beings operating the machines.
Exactly. When a futuristic mega project requires a highly skilled workforce of more than 3,000 people in a location where the nearest hospital, grocery store, and power grid are 400 miles away, the ultimate constraint on the project is no longer the availability of capital. It is no longer the complexity of the engineering.
It's the basics.
The ultimate constraint is land and housing. If you cannot reliably house, feed, and protect the workers, the project simply does not exist. It dies on the drawing board. Looking at the data, Civeo is quietly and deliberately positioning itself as the ultimate bottleneck asset for the next decade of North American industrial expansion. If you truly believe in the coming infrastructure supercycle, you have to look very closely at the companies that hold the keys to the temporary cities that make it all physically possible.
That is a brilliant framework. The ultimate bottleneck asset. The toll booth on the road to the global infrastructure supercycle. Well, thank you so much for breaking down the intricate mechanics of this incredibly complex yet absolute vital sector of the economy. And to you, the listener, thank you for tuning in to this deep dive. We hope we successfully cut through the noise, translated corporate jargon, and armed you with the hard data and actionable insights you need for your portfolio. Keep digging into the fundamentals, keep reading the transcripts, and keep doing your own rigorous research on these vital market signals. Because as we saw today, the real story is never just printed in the headline numbers. It's hidden in the mud, the diesel supply chains, the convertible debt structures, and the balance sheet. Until next time.